Well, good morning and welcome to our next webinar in the series that we're holding. This one is about renewables in China, the road ahead, and lots of changes coming up in China and some expert analysis to share with you. My name is Matt Brown. I'm Vice President at A3 Management Consulting. And if you skip on Christian through the next slide, we're just going to say here that ask questions throughout the webinar. We had some questions from the registration. We will pick up some at the end if we have time, and if not, we'll get back to you directly in answering questions. The slide pack and recording will be emailed, will be available and sent out. So if you drop off for any reason, any issues, there will be a recording of the slide pack so you can pick it up later on. Maybe I'll just introduce the other two people on the webinar, the people who are doing most of the heavy lifting here, of course, Christian Romig, who is based in Beijing and heads up our management consulting in China, and Rob Lee, a senior consultant who's based in the UK now, but has recently spent quite a lot of time out in Beijing in working to produce all this analysis. So with that, I'll hand over to Christian to take us through. Thank you very much.
Brilliant, thanks Matt, thanks for the introduction. So just to get started, I wanted to say a little word about what we'll be covering today. So I'll be talking a little bit about the background to the recent evolution of the Chinese electricity system and focusing in particular on wind and solar, as well as providing some of the some insights into some of the key issues facing wind and solar in the market at the moment. Rob will pick up towards the end of the presentation on our forward look over the next 30 years for the market based on our modeling results. So just to get started, in terms of context, obviously when thinking about the Chinese electricity system, scale is absolutely key, and the scale of the Chinese system is immense. Just in terms of demand here, you can see that in 2019, the Chinese electricity system was roughly equivalent to 2 times that of Europe, 12 times Germany, and 20 times the UK. So obviously, coming with that is huge opportunities, equally large opportunities as the system decarbonizes for renewables, and also a equally large scale in terms of the challenge of decarbonizing the electricity sector, and we'll be touching on both of those today. It's also, and you can see here by the fact that we've got lots of lines indicating different provinces in the map on the left, it's also not a single block. So you can't think of the Chinese electricity system as a single block. It is really 30 very diverse, very different provinces. And that's also certainly an important factor to bear in mind when approaching the market. Now, just looking at the recent history over the last decade, one of the key features that emerges here is really substantial growth. So just in the last 10 years, we've seen the Chinese economy grow by something like 140%. And that has meant that there's been an addition of something like 3,000 terawatt hours of demand to the electricity system, which represents growth of about 70%. Now, you can see from the chart here on the left that most of that demand is being met over time by thermal generation, which is mostly coal in the Chinese system. There's a lot of coal resources available in China, and that feeds through into the composition of capacity and generation in China. But also a lot of hydro generation, 1,200 terawatt hours last year, and you can see a growing proportion also of intermittent capacity, intermittent generation on the system there, with something like 30% of generation from low carbon sources in 2019. Now, obviously, one of the features of the system is this remarkable and really huge growth in renewable capacity just over the last decade. So we've seen it rise from almost nothing in 2010 to over 400 gigawatts. So China is obviously the world's largest renewable energy market now. And this has been driven obviously by falling costs and government subsidies and obviously an expanding market opportunity as demand expands as well. And we expect this growth to continue in the long term. Rob will talk about this a little bit later. In particular, you can take as a sort of indication the Chinese government's own target. So we've got here the first target, the first key statistic. This 50% target for non-fossil fuels in total final energy consumption by 2050. Obviously, as electricity plays a more important role in final energy consumption in China in the future, as electrification of transport progresses and obviously of industry as well. This is going to be a big driver of deep decarbonization in the Chinese electricity sector as well. So this sort of ambition in the long term offers a bit of insight into what we can expect in the future. Certainly a carrying forward of the previous trend. Realizing this will obviously be complicated to a certain extent by China's geography, and you can see here from the map that we have really a significant mismatch between the locations of energy resources and where we find the major demand centers in China. You can see here we've obviously got lots of good renewable resources, high wind speeds, good radiation in northern and western regions. We've got coal, hydro, other energy resources dotted around the country, but we've really got the main coastal demand centers on the east and south along some of the more well-developed, advanced provinces with bigger populations and bigger urban centers. Now, this has meant that China's energy planners have had to direct a lot of investment towards the development of a huge transmission system, and we've seen that expand over the last decade quite significantly. You can see from the chart here on the right. Now, obviously, this is absolutely key to how the future system will be operated. It will really be across different provinces and across different regions. But certainly as well, this interconnection and how it's used will play a very big role in integrating renewables in the future as well. In a little bit more detail here, we show how, in particular, the geographic spread of resources, different energy resources across China, plays out at the provincial level. So we show a few key statistics here for different provinces across demand, across exports, imports, and obviously the nature and composition of capacity. And you can really see here from some of the provinces, mostly in the west, Xinjiang, Shanxi, Yunnan, these are playing the role of exporters, and in the east, obviously, you can see that there's significant net imports from these different provinces. Also, there's really big diversity in how each individual provincial system looks. So Yunnan, obviously, with a lot of hydropower, Xinjiang with growing or big proportions already of renewables on the system, and some of the eastern provinces and southern provinces with still quite a lot of coal, but also nuclear and other technologies. Now, this diversity in the longer term is very much an opportunity. As markets evolve in the Chinese electricity system across different provinces, there will be opportunities to take advantage of price differentials that we already see, both in terms of fuels, but also in terms of actual electricity prices between these different provinces. And obviously for renewables in the longer term, it also represents a big opportunity for the system operators to deploy this diversity of resources across different regions in different time frames in order to be able to help solve the intermittency challenge. Individual provinces will not have to go at it alone. They will be able to draw on resources across different provinces to balance the system. Now, integration itself has been a challenge. You can see here already just from the chart at the bottom left, we've seen significant levels of wind and solar curtailment in China, significant volumes as well. Obviously, the longer term trend here since 2016 is downwards. We see curtailment levels coming down to below 4%. The government's own target for next year is 5%. So these targets have already been met, and the problem is being alleviated. On the map on the right here, you can see how the geographic mismatch plays out. With higher curtailment, obviously in regions with a lot of renewable resources, in particular higher wind speeds in this case, that are more distant from the load centers experiencing higher levels of curtailment. Now, obviously, the downward trend in curtailment levels is a positive one. It's one that's come about with the expansion of the transmission network, changes to how dispatch is working, with renewables being given priority dispatch in certain provinces. And obviously, in the long term, looking ahead, as China's market reform program progresses, we see the system being operated on a much more flexible basis, and we would expect this particular challenge in terms of curtailment also to be kept under control moving forward. So that will be alleviated significantly also as markets progress. Now, moving on to some of the revenue mechanisms that are at play, in particular for utility wind and solar here. Obviously, we've got the feed-in tariff scheme here, which has been one of the main drivers behind China's rapid expansion in renewables over the last decade. And you can see here in terms of the revenues, it offers a fixed energy price for 20 years on top of the coal benchmark price for power, which you can think of, the coal benchmark price, you can think of as a sort of proxy for the for a wholesale market price here in China at the moment. But you know, as we've seen in many markets around the world, as renewables here have expanded much faster than anticipated, China's fund for supplying these subsidies has run out of money. And this has led to a large number of policy changes in recent years. It's led to payment delays. So despite the attractiveness of the scheme, it really still represents quite high policy risk, quite a lot of uncertainty for generators. So partly in order to deal with this challenge, the regulator, the National Energy Administration, has put into place new contracts, these grid parity PPA contracts that we highlight here, where new capacities of wind and solar, utility scale wind and solar, are encouraged to come forward at the local coal benchmark price without a national subsidy. There may be additional sources of subsidies, potential local subsidies or green certificates, again with a fixed price for 20 years. So really quite an attractive proposition. Now, in our view, this shift is broadly positive. We see with grid parity contracts, depending on how they play out, obviously a lot less policy risk, a lot less payment risk. Renewables are already cheap, so wind and solar, in particular solar, is already cheap in the Chinese market, and relative to the coal benchmark price, in these different provinces, it's quite possible to secure adequate IRRs from this type of arrangement. Now, obviously, in the future, moving forward, this is likely to bring forward quite a lot of fairly expensive renewables at coal benchmark prices now that are still quite high. So there's some big question marks around how long this scheme will be in place. What is clear is that moving forward, new renewables will be exposed to markets considerably more than they currently are, and then obviously there will be lower subsidies or potentially no subsidies in the longer term, even at a local level. I've mentioned market reforms in China a number of times. It's worth noting that this has been underway now for a number of years. We've got 8 provinces that have already implemented, that are on the cusp of implementing competitive spot markets. So all the other provinces have already put into place forward markets. Now, at the heart of these reforms is a change to how the system's operational philosophy is delivered. Currently, we've got about 70% of volumes on the system that remain planned, and this is what we show here at the bottom left. We have an annual generation plan which is drawn up by regulators in the TSO. They then allocate generation hours, full load generation hours for individual generators with some other conditions for that particular year. The dispatcher's job is then to ensure that these hours are going to be met by these individual plants and allocate potential shortfalls between the generators. Obviously, in a more intermittent world, this hasn't been working very well, and it's been a significant source of the inflexibility which has brought about the high levels of curtailment that we've seen previously. So this is shifting now, obviously under market reforms, towards a more market-based dispatch mechanism where plants will be dispatched based on market outcomes. We see this bringing a lot more flexibility into the system and how it's operated, as well as a number of other changes, which will include how prices are being set, how often they change, and also in particular how wholesale market prices actually look over time. So here we show how the previous proxy for wholesale market prices has been set in the past, the coal benchmark price. This is a cost plus price for coal generators. And really can be considered the wholesale market price, since most of generation is coal. Now that has been transitioned as of this year to essentially a base price with a floating adjuster, which allows regulators to adjust prices based on market conditions on a more regular basis. Now, obviously, as wholesale markets are implemented, we will see prices being set on an hourly or sub-hourly level, and we will also, we expect prices to be significantly lower relative to these benchmarks. Additional impacts that we might see from reforms will stem from, in particular, reforms to how dispatch works. So we'll see renewables being dispatched more often, less renewable energy curtailment. Obviously, pressure as a result on inefficient coal plants, all of that will bring about lower emissions. Potentially as well, an expansion of trading between provinces and between regions in order to balance provincial electricity markets. And finally, obviously, some of the savings on the wholesale market side being passed through to the retail side with lower consumer bills. So that said, in terms of the background, I'll hand over at this point to Rob to talk about our view of how things are going to look over the next 30 years. Rob, over to you.
Great, thanks, Christian. Can you flick it onto the next slide?
Yep.
Excellent, thanks. So I'm going to talk a little bit about the future drivers of the electricity market in China. But before I do, it's probably worth saying that all this analysis has been done in Bit3, which is our in-house electricity market model, and it underpins all of the projections we do globally, including sort of European projections, US projections, which we're quite well known for, and the further afield projections as well. We also license the model to our clients, so it's sort of market tested, if you like, and that includes a number of large utilities and grid companies that use it for their own internal analysis as well. And for those of you who aren't familiar with our scenario approach, all the analysis is based on our central scenario. And to cut a long story short, it's sort of our best view of the future electricity landscape. But we do run a number of other scenarios as well, because there obviously is a lot of uncertainty in the future outlook for energy markets. So I'm going to start by talking a little bit about the volume and composition of electricity demand, go on to talk about the future generation and capacity mix, so what's meeting that electricity demand, then a bit about technology costs, so why the winners win out, and then a little bit about prices. So if you want to flip on to the next slide, Christian. And moving on to demand, I think it's just worth saying that, you know, electricity demand, as Christian said, has grown quite rapidly over the last sort of particularly 2 decades. But we're expecting that demand growth to slow as economic growth also slows. We still see about 3,500 terawatt hours growth over the next 3 decades, which, if you think back to the first slide, that's roughly the electricity demand of the whole of Europe. So it still represents a massive opportunity for investors and developers in this space. So just talk you through the chart quickly. The green is sort of industrial and commercial. So at the bottom, we've got tertiary, which is services. Then we've got manufacturing above that. Agriculture and mining above that, so primary industry, that kind of thing. In the dark blue, we've got electric vehicles, in the light blue, residential, and then losses in grey at the top. So what we see is as GDP growth begins to slow, it also begins to shift in China towards the tertiary sector. So we're seeing a lot more growth in services away from the traditional manufacturing sector. And that means that also electricity demand growth slows because the tertiary industry is a lot less energy intensive than the secondary industry, which is one of the big drivers of slowing. But on the other side, we do see quite substantial growth in electric vehicles. So China already has the biggest electric vehicle market in the world, and we're expecting that trend to continue. That sort of rollout of EVs as part of a national priority will continue into the future. And we see around 1,000 terawatt hours by 2050. And that's a combination of the electrification of transport, but also as vehicle ownership grows slightly in China as well. China's quite dependent on oil imports. So from a national sort of energy security perspective, if you can generate the electricity locally, it makes sense to have your transport sector running on electricity, as well as the decarbonisation aspect of it. So it's sort of killing 2 birds with 1 stone there, as it were. Okay, Christian, if you want to flip on to the next slide. Okay, so what's going to be meeting that demand? So as you can see here, primarily we see quite a large growth in wind and solar. I'll just talk through the colors very quickly. So at the bottom we've got hydro, then above that in the 3 gray colors, that's the 3 coal technologies, so sub, super, and ultra super critical coal. And then we've got lignite, CCGTs. In the peachy color, we've got nuclear, green, wind, PV in the yellow, and batteries in the purple. In the other category, we mainly have blast furnace gas and biomass and waste, which is also growing over time. So coal's still got quite an important role to play, at least in the next 2 decades, as it's still quite a substantial proportion of the generation mix. But importantly, we don't see it growing massively over time as people have been expecting. So there's quite a lot of articles around today about coal growth and under construction plants. But actually, we see a sort of slowdown in the coal sector and a growth in the renewable sector, and that's primarily due to the cost, which we'll come on to. So we see around 4,000 terawatt hours of growth over the next 3 decades, which is substantial. So it's bigger than the total electricity demand of Europe, so relatively large. And nuclear as well, which is another low carbon technology, playing a big role in the coastal regions, where you can get access to the water. As you get further inland, it gets more difficult to develop nuclear. But nuclear, relative to the rest of the world, is quite cheap in China. So it makes sense to build that in the demand centers where you see a lot of the demand for growth in the future as well. as coal begins to decline and retire, batteries will become more widespread and important, partially integrating the intermittent renewables into the system, partially to provide firm capacity when the wind isn't blowing and the sun isn't shining. So we see the durations of those batteries getting longer over time as the system evolves. And what does that mean for capacity? If you want to move on to the next chart, Christian. So again, we see substantial growth in wind and solar, so 2,000 gigawatts growth over the next 3 decades. Which is roughly 5 times what's installed today. So there is sort of a speed up in deployment, but it's not substantial. So it's not unobtainable speed up in the deployment of new capacity for wind and solar. In the near term, we see sort of limited needs for new thermal plant. It will probably be regional. There are some regions where there's a sort of deficit of capacity, but overall the situation is that coal is quite widespread and there's quite a lot of excess capacity on the system today. Batteries also playing a limited role in the near term, but getting more important over time as that coal begins to retire. And again, sort of the other thermal technology is growing very, very slightly and then declining towards the end of the period. Nuclear playing an important role through the 30s and 40s particularly. We do see some growth in hydro as well, but to really develop hydro substantially, you'd need to move from the hydro basins at the moment, which is sort of Yunnan and Sichuan province in the southwest, up to Tibet, and actually trying to develop that sort of that capacity at the altitudes on the Tibetan plateau, and then export all the power across to the eastern load centers it looks quite expensive compared to building lots of solar and wind. So if you want to move on to the next slide, Christian. Thank you. Okay, so this is sort of trying to illustrate why we see onshore wind and solar winning out in the longer term, and batteries as well. So if you look at the chart here, these are showing LCOE, so the levelized cost for electricity, or the revenue that you need to receive per megawatt hour of electricity to make the investment case stack up for wind and solar. The solid line is showing the average across the provinces, and then the range is showing the range based on the load factors. Obviously, there's a bigger range for wind because there's a bigger variation in wind than there is in solar, due to the fact that the load factors are simply higher. And then we compare that to what we think a new coal plant today would need, and you can see already wind and solar are looking cheaper than coal. So we really expect them to be the big drivers of growth going forward. Simply due to the cost, it's just cheaper to build them. There's enough coal capacity on the system to integrate the renewables. It's going to need to run more flexibly. We're going to need slightly more transmission capacity, but we think that wind and solar look relatively attractive today in comparison to building a new coal plant. And on the right there, you've got the annualized cost of a battery. So that's the sort of RMB per kilowatt per year that you need to receive in gross margin to make the investment stack up. It is already cheaper to build sort of 2-hour batteries, and it's getting cheaper to build 4-hour batteries. We see the costs roughly halving over time, but there's not that much need for firm capacity in the near term, which is why we don't see them being as widespread. They'll be more limited to providing grid services and specific use cases, I think, in the near term, before we see that really widespread, 500 gigawatt deployment of batteries. So Christian, if you want to move on to the next slide. So I thought I'd just leave you with this one, which is our wholesale price projections for each of the provinces in China, and each line represents a different province. And you can see here that there's a huge range in wholesale prices. The top price provinces are roughly double that of the lower price provinces, and it's really going to depend on the local fundamentals. So the technology mix, the fuel cost, the demand growth, everything that is in the province and in the neighboring province will be very important to make the right investment decisions. And with that, I'll hand over to Christian to wrap up. I appreciate we're running pretty short on time here.
Excellent, thanks, Rob. So just a couple of closing words, obviously, on renewables, and then on some thoughts for some of our viewers who are from the investment community. Firstly, on the future of renewables here, obviously from our perspective, it's clear that the current direction of travel for renewables is that they will play really a significant role in China's energy future, and our modeling supports this. Certainly, we can see from the capacity and generation projections that there will be a significant expansion for wind and solar in the future. Obviously, along the way, key drivers to make this happen will have to include continued government support in a number of ways. Obviously, renewables, wind and solar will have an increasingly strong value proposition as the costs continue to decline, which we've seen from the LCOE charts. And of course, market reforms will help to multiply the opportunities and also the options to offtake those volumes from those new capacities. But obviously, as we've highlighted, this to a certain extent will be dependent on the pace of reforms and the efficient use of those interconnectors that we've already mentioned. Obviously, for our viewers from the investment community, we do see big opportunities in renewables in the Chinese market. Obviously, accessing these is going to require a really good understanding of what is essentially a very different market environment, in particular in terms of the policies, how things are operated, hour allocation, dispatch, and obviously as well how the support schemes are changing and how contracts work at the moment in the Chinese system. Also, obviously, understanding how the markets are evolving, how those will impact on a range of different assets, and also how those assets will be making revenues in the market is going to be absolutely key. And finally, as we've mentioned, there's huge diversity across the different provinces. It will be absolutely key moving forward when approaching the market to take a provincial look rather than a sort of very broad brush national look. With that, obviously, we can help. We offer a number of services here in the Chinese market. We have a number of off-the-shelf reports that we can deliver. Obviously, we can do bespoke studies with a focus either on different technologies or different regions or different issues within the market. Rob mentioned our modeling. We have now developed that for every single province and can offer hourly prices for wholesale prices, but also take a forward-looking view of how the markets are going to evolve in individual provinces, and a range of other services that come with that, including scoping, as well due diligence and transaction support. And finally, we can also help with our wider network and experience across A3 management consulting. We can help develop internal structures, practices, systems, teams, so on and so forth, to adapt to China's changing markets, trading strategies, risk management policies, so on and so forth. And finally, of course, we can help you to understand how the market design is changing in China as the liberalization takes place, and offer you advice on many of those aspects as well. So with that, I'd like to say thanks to everybody for joining and for your attention. I think we may not at this point have time for questions. I'm not sure, Matt.
Yeah, no, I think if for those people who can stay around, why don't we just hit a couple of interesting questions that I've seen that have come in, and I think that's fascinating to see. Number one, what we're doing in terms of the detailed, granular analysis we can offer, and number two, the developments in China are just staggering. In terms of size and scale and opportunity, it's incredible. And we've already been working for lots of players who've been entering the Chinese market. So we're helping people with their market entry strategy, with their due diligences and so on. So it's just, I think it's a very vibrant situation. So let me hit a couple of questions then. The first one, I would say, question here about renewable integration. So China's the top producer of renewable energy. You talked a little bit about integration and how things have been changing. How can China tackle the challenge of further renewable energy integration, which I know is a key question on the minds of those running the system.
Yeah, I mean, that's a really excellent question, and certainly a topical one that's being debated at the moment here in market design circles in Beijing. I mean, I think it's clear, and I've mentioned it a number of times, that obviously accelerating the market reforms will have a big impact on the future, on being able to integrate these huge future capacities of, in particular, intermittent generation that we see coming forward. Those market designs will have to ensure, in our view, that trading is able to take place up to close to real time in order for the short-term price signals and short-term operational signals to be able to account for the intermittency that we'll see as more wind and solar comes onto the system. Obviously, using the current interconnection and developing it to a certain extent as well will be key. Investing in more transmission infrastructure will be important to be able to enable those flows of renewables from distant regions over to the major load centers. As well, reforming how those transmission assets are priced will be key. China at the moment has a very inflexible pricing model for transmission, and so some reforms to that will be important to be able to integrate flows from transmission networks into provincial markets on shorter timeframes. Obviously, the integration of individual provincial markets will be key in the long term to enable individual provincial markets to be able to draw on a diverse range of different resources across provinces and across regions in different timeframes in order to be able to deal with that intermittency. As well, ancillary service markets will have to be introduced and accelerated with the procurement of reserves and other services at short timeframes as well in order to be able to account for the intermittency that will be seen on the system.
Okay, thanks for that. And another question in here, which maybe we just do this one as well, because I know it's one that's probably a question that a lot of people would have, and that's obviously there are a lot of large state-owned entities in China who are operating in these markets. Do you think foreign investors can thrive in China?
Yeah, so obviously when we're looking at wind and solar, it's true that most of the wind capacities that have been developed are owned by state-owned companies, but that's not the case for solar PV. So there is some distinction. The current market reform program in China is opening up the market, and it's making it more familiar, let's say, to foreign investors. The mechanisms that are being put into place are much more similar to what we see in more advanced, more developed electricity markets. So there is a value which is placed on that knowledge and that expertise, and certainly opportunities for partnerships to develop projects here in China, and obviously to operate assets as markets evolve. Certainly as well, the introduction of more competition will mean that there will be greater value placed on that knowledge, and we definitely see the opportunity expanding also for foreign investors. I mean, the fact is, if you look at the scale of the investment which is required to be able to deliver that capacity in the long term, it's not just going to be possible for Chinese investors to cover it all. It's going to be a more global effort in the longer term, certainly in our view. So certainly big opportunities. The market is changing, is opening up, and certainly worth having a look at it.
Lovely, thank you for that. Well, I think we'll wrap it up there. I think it's very interesting. You can see, and I'd like to thank Christian and Rob for that and all the work that's been going on. Also, Bev and Johnny and others who are helping us put this webinar series on. Next week, we've got a webinar looking at operational aspects of the energy sector and how to bring digitalization in to uncover hidden value. Please sign up for that if you are interested, and we'll, as I said, we'll send the slides and the recording around later. So I think with that, thank you, and hope to see you next time. Bye-bye.